Hi, welcome to the channel Too Irrational. I'm Pranay Sharma, and in this video we are going to discuss the solutions of CM1A conducted by IFoA Institute in April 2023. We'll go through the solution as well as the explanation of each answer. If you want the solution sheets, I will list down the number below in the description where you should WhatsApp message or Telegram your email ID and ask for CM1 solutions. We will email you the same. Now let's get started. Question 1, first part. Describe in words A deferred, B, Q, X, select X plus 1. So that is the probability of dying between ages X plus A plus 1 and X plus A plus B plus 1 for a life aged X plus 1 exact selected at age X. So the few things that are going to be very important is that selected at age X, currently aged X plus 1, died within B years, deferred for A years. However you write it, these are the few things that you will have to mention properly. Then second part, calculate showing all working, 5 deferred, 3Q, select 38 plus 1. And the mortality is AM92 select. So you can write it in terms of P and Q. You can say it is 5P select 38 plus 1 and then 3Q 44. But I have directly written it in terms of L. So we have L44 minus L47 upon L select 38 plus 1. That comes out to be 0.00438,516. Let's go to question number 2. A general insurance company has set up a generalized cash flow model for the claims payment it will pay arising from its portfolio of car insurance policies. Describe the cash flow with reference to certainty and uncertainty of size and timing of the payment from the insurance company's point of view. So this is from the theory chapter where we'll have to describe the cash flows. So for income, we say positive cash flow at the beginning of each anniversary of purchase of the car of a certain amount for uncertain number of years of life of the car. So the positive cash flow that is at the beginning of each anniversary of the purchase of the car, and it is for uncertain number of years. This is important, and of course the certain amount that would be paid. Then for outflow, we have negative cash flow at the uncertain time of the accident of car of uncertain amount within uncertain number of years of life of the car. So here everything is uncertain. We don't know the time of the accident, the amount that will have to be paid, and the number of years for which this policy would run for. Let's go to the third question. Question number 3, calculate A 82 1 by 4, that is 82.25, payable 4 times, showing all working, and the basis is PMA 92C20, 4% interest. So here I have made the equation from A 82 payable 4 times because only one cash flow of 0.25 is not included here, that is at time 0.5. And after that, we will have A 82.25 payable 4 times. This A 82 payable 4 times comes from the PMA 92C20. We'll have A due 82 from that table and minus M plus 1 by 2M, that is 5 by 8. That gives me 6.426. Then for this probability, you can use either UDD or CFM. You should mention that whichever you are using, and I think both will be accepted. You have to just take one of them, not both of them. So using UDD, I found out the probability, and the A82.25 payable 4 times comes out to be 6.3502. And using CFM, I've calculated the probability, and the value we get is 6.3532. You can also relate this to the next value, that is A83 payable 4 times, but the problem would be you will have to have 3 different probabilities in that case. So this was more convenient. That is why I preferred it. Let's go to the next question. Question number 4. A life insurance company sells 1-year pet insurance policy. If the pet dies during the year, the sum assured is payable at the end of the year. If the pet escapes, no benefit is payable and the policy is cancelled. The company uses the following dependent decrement rates to price these policies. So they have given us AQ for death as well as escape. The company assumes that the force of decrement are constant over the year and that the two decrements operate independently and the independent and dependent forces of decrement are equal. The company has proposed reducing the underlying independent mortality rate to 70% of the current value. Calculate showing all working the proposed new dependent decrement rates. So for this, you will have to calculate the mu xd and mu xe for both of them. In the new values, we will say that qxd star is 0.7 of the qxd that we get from here. And accordingly, again, I have calculated the mu xd star. Using that, we'll have to calculate APX, AQXD and AQXE. That is what they are asking for. Let's go to the next question. Question number 5. The gross future loss random variable at inception for a policy issued to a life aged 50 exact is given by this. So we have 1500A minimum of K50, 15. So that's a 15-year temporary annuity in arrears. And we have 35 A due minimum of K50 plus 1, 15 minus 1. So that must be the renewal expense, that is except for the first year, plus 200, that becomes the initial expense, minus 0.97 into P. So we have a single premium where commission, or you can say initial expense, is 3% as well. Describe in words the timing and the amount of the benefit, expense and the premium of the policy implied by the gross future loss random variable. So we'll say a 15-year temporary annuity benefit pays 1500 per annum in arrears till death or maximum of 15 years to a life aged 50 exact. For a single premium P payable at the beginning of the policy, the initial expense is 200 and 3% of the single premium. You could write 3% being a commission. Okay. The renewal expense 35 at the beginning of each year except the first year for a maximum of 15 years or earlier death of the policy holder. So for each one of them, you have to specifically mention the cash flow and the time of the payment as well as the number of years for which we are going for. Let's see the next question. Question number 6. A life insurance company sells a special 15-year pure endowment assurance policy where a sum assured of 10,000 is paid at the end of the term if the policyholder remains healthy throughout. The following 3 states transition model is used. So even though this seems like a transition model, you can assume it to be a decrement model as well. That will not be a problem. First part, show that the expected present value of the benefit in respect of a healthy life aged 50 exact is approximately equal to 1054. So the benefit of 10,000 would be given only if the person remains healthy throughout the policy. So we'll calculate the probability of remaining healthy at time t. So that would be e raised to minus of 0 to t mu plus sigma ds. So that is e raised to minus 0.12 t. So the expected present value of benefit would be 10,000 discounted for 15 years and given only if the person remains healthy throughout those 15 years. So put t is equals to 15. And we are getting 1053.99, approximately 1054. For the second part, premium of P per annum are payable continuously throughout the policy term. ceasing on death or if the policyholder becomes sick. Calculate P showing all workings, and the basis is given here, mu is given, sigma is given, and force of interest of 3% is given. So the expected present value, we'll say premium would be paid continuously, so 0 to 15. Payment given at time t if the person is healthy throughout till time t. So solving that, we'll get 5.964p, and therefore premium is going to be 176.727. Let's go to the next question. Question number 7. An organization is required to pay 5 million in 18 years time. It holds a cash fund equal to the present value of the liability and wishes to use the whole fund to purchase a combination of 9-year and 20-year zero coupon bonds in order to immunize against small changes in interest rate. The current interest rate is 8% per annum effective. Calculate, showing all working, the proportion of the cash fund that should be invested in each of the two zero coupon bonds. So we'll calculate the present value of liability, and then I'm assuming the amount, nominal amount of zero coupon bond that we are buying is X and Y. So accordingly, we are getting 0.50025x and 0.21455y. We'll make equation 1 by equating these two. Then I'm taking the numerator of DMT for both of them. So we'll have to multiply by the time here as well as here and make an equation by equating them. Then simultaneously solving both of these equations, we'll get the value of X and Y, that is 0.454737 and 4.77167. But we want to also show the proportion of cash that is used in that is invested in 9-year zero coupon bond and 20-year zero coupon bond. So that would be the present value of the bond divided by overall present value. So it comes out to be 18.18% in 9-year zero coupon bond and 81.82% in 20-year zero coupon bond. For the second part, the organization invests in two bonds in accordance with the proportions calculated in part 1. Second, estimate using the volatility the percentage change in the present value of the assets if the interest rate were to increase to 8.5% per annum effective. You should show your working. So from 8%, the interest rate is increasing to 8.5%, that is 0.5% increase. So there will be a decrease in the present value. So the first thing is I've calculated the volatility. It is V times the DMT. That turns out to be 16.667. And then approximate change in present value upon present value would be nothing but negative of volatility into the change in interest rate. So that turns out to be 8.33% and it is negative. Let's go to the next question. Question number 8. A life insurance company issues a retirement policy to a male policyholder age 60 exact. The policy provides the following benefit: an immediate whole life level annuity of 25,000 per annum payable monthly in advance, a revisionary annuity of 15,000 per annum payable monthly in advance to the policyholder's surviving female spouse who is currently age 62. So here they have used the word revisionary annuity and surviving female spouse. That means this annuity would be given after the death of X. A lump sum of 200,000 payable immediately to the policyholder's family if the policyholder dies before age 65. Calculate the expected present value of the policy benefit at the outset. You should show all working. Male is PMA 92C20, female is PFA 92C20, and rate of interest is 4%. So the equation 25,000 ADUX payable 12 times. I have written here x is 60, y is 62, and 15,000 would be payable on death of x given to y. That's the revisionary annuity. Then the assurance 200,000 payable immediately on death of x if x dies within the first 5 years. We'll calculate each one of them from PMA and PFA 92C20. For the assurance part, you will need A bar x. I've missed x here. Okay, A bar x minus v raised to 5, 5px, A bar x plus 5. So for that, we'll calculate A bar x and A bar x plus 5 from these formulas. And the expected present value is about 416,021.835. So the revisionary part may be confusing, otherwise it was very straightforward. Let's go to the next question. Question number 9. A government issues a fixed interest bond paying coupon at a rate of 9% per annum payable half yearly in arrears. The bond is to be redeemed at 110 per 100 nominal on any coupon payments date from 10 to 15 years after issue. The date of redemption is at the discretion of the government. I think there is a small mistake here. It should be discretion of the investor. Investor A is subject to income tax at 25% and capital gain tax at 30% and wishes to achieve a net redemption yield of at least 6% per annum effective. So first thing we'll have to figure out is whether there is a capital gain and which date would we redeem it for. So calculate showing all working the maximum price per 100 nominal that investor A should offer for this bond on issue. So we'll do the capital gain test. We have capital loss, therefore we will choose the lower time, that is n is equals to 10. Accordingly, we'll calculate the price A would pay. Because we have capital loss, we will not have any capital gain tax. So the price comes out to be 111.838 per 100 nominal. Next, investor A purchased the bond at the price determined in part A, part first. 3 years after issue, immediately after the coupon payment has been made, investor A decides to sell the bond to investor B. Investor B is subject to the income tax of 10% and capital gain tax of 35%. So you can see that the taxes are different here, so you will have to be vigilant about it. And wishes to obtain the net redemption yield of at least 8%. Again, everything has changed, taxes as well as the net redemption yield. So second is calculate showing all working the maximum price per 100 nominal that the investor A can expect to receive from investor B. So we'll have to calculate. First of all, 3 years have gone, so now the redemption date would be either 7 years or 12 years. So we'll have to figure that out using capital gain test. So for investor B, we'll do the capital gain test. Remember, I here will be according to 8% and tax according to whatever was given for B. So we can see we have capital gain, so n is equal to 12. It is the later date from the point B buys. That would be 3 years after A had bought that bond. So we'll use the formula to calculate the price B would pay. We'll have to include both the taxes, but again according to investor B. And we get 105.264 per 100 nominal. Now for the third part, the bond is sold to investor B at the price determined in part 2. Calculate using linear interpolation the net effective annual redemption yield that will be obtained by the investor A. You must show all your working. Even though they use the word linear interpolation, what I use is calculator table mode to calculate these things. If you want to understand exactly how, I have listed in the description the calculator videos. You can go through the table mode video. So for investor A, he was paying taxes at 25% on coupons that was received for 3 years and then sold to investor B at a loss, because you can see here we have 105 whereas he bought it at 111. So we have capital loss, so we don't have to consider the capital gain tax here. And you can show the interpolation. I have directly used the table mode of the calculator to figure out I is 4.22%. Let's go to the last question. Question number 10. A life insurance company issued a 15-year special endowment assurance product on 1st January 2013 to a portfolio of policyholders aged 50 exact. The benefit were as follows. We have a death benefit payable at the end of the year of death of 100,000 during the first policy year, which reduces by 5,000 each subsequent year. Survival benefit of 20,000 payable on survival to each of the 10th and the 15th policy anniversary. Level annual premiums are payable annually in advance, ceasing after 10 years or on earlier death. Show that the annual premium is approximately equal to 2,786. You must show all your working. Here, for expected present value of benefit, we'll first calculate the decreasing assurance, and then 2 times at time 10 and time 15 we have survival benefit of 20,000. The expected present value will have A due 5010 because the premium is paid only for the first 10 years. This directly comes from the table book. So here I have calculated the term assurance and increasing term assurance as well as the survival benefit values. So we get premium as 2786.37, that is approximately 2786. For the second part, on 1st January 2022, there were 225 policies in force and 2 policyholders died during 2022. Calculate showing all working the mortality profit for this portfolio for 2022. So for the second part, we have to calculate 10V, that is the reserve at the end of the 10th year. For that, I would want the benefit given at time 11, and according to that, I will make the decreasing assurance plus 20,000 survival benefit after 5 years. So this reserve is after the 10th year. That means all the death benefits as well as the maturity benefit at time 10 has already been paid. So the reserve that I'm getting is 15,845.78. Using that, we'll calculate the DSAR. DSAR will have S10 minus 10V plus 20,000, because if a person dies, then this 20,000 would also not be given to that person. That was the survival benefit at time 10. So S10 would be 5,000 more than this, that is 55,000. Accordingly, I got DSAR as 19,154. So if you forget about this 20,000, then you will definitely not get marks after this point. Then we'll calculate the expected death strain as well as the actual death strain, and our mortality profit is negative 7537.186. Third part is explain your result in part 2. So we'll say there is a loss of 7,537.186 because death strain was positive and actual deaths were more than the expected deaths. That was 1.6 and the actual deaths were 2 deaths. That ends our paper. The overall paper was very straightforward, very simple. We did not have to use any Excel, and except for 1 or 2 places, the questions were very straightforward. So I am expecting a high passing mark this time, but it will definitely depend on paper B as well. Overall, it took me about 2 hours and 40 minutes to complete. So paper was not really lengthy. You could have easily completed it in 3 hours and 20 minutes. I'll soon be releasing paper B solutions in maybe 1 or 2 days. So do subscribe so that you get the notification for it. Also like and share this video, and I will see you in the next one.